Hello, in this video we will discuss about finance. So we will first read out the questions and then we will discuss about the answer in more detail. So let's start. So the first question is, what is finance? So finance is the discipline of managing money. It encompasses activities like budgeting, investing, saving and borrowing. So essentially finance guides how individuals and businesses handle their financial resources, making decisions that align with their goals. Finance involves understanding how money works, both on a personal level, where individual budget to meet where individuals budget to meet their needs, or on a broader scale, where businesses strategize to maximize profits and minimize risks. Second question is, why is budgeting important? So budgeting is crucial for effective financial management. It involves creating a plan for how you will spend your money, considering your income, expenses, and saving goals. A budget ensures that you will live within your means, avoid unnecessary debt, and allocate funds to important priorities. By tracking your spending through budgeting, you gain awareness of your financial habits, identify areas for your improvement, and make informed decisions about where to save or spend. Essentially, budgeting is a roadmap for the financial success, providing control over your money rather than letting it control you. Third question is, what is the difference between stocks and bonds? Stocks and bonds are two common types of investments, but they function differently. When you buy a stock, you are buying a piece of ownership or equity in a company. As a shareholder, you may benefit from the company's profits through dividends or by selling the stock at a higher price. On the other hand, a bond is a loan you provide to a company or government in exchange for a periodic interest payments and the return of a principal when the bond matures. While stocks offer ownership and the potential for higher returns, bonds provide regular income and are generally considered less risky. Fourth question is, what is interest? So interest is the cost of borrowing money or the compensation for lending money. When you borrow, you pay interest to the lender as a fee for using their money. Conversely, if you lend money, you earn interest as a reward for allowing someone else to use your funds. Understanding interest is crucial for loans and savings. The interest rate determines how much you will pay or earn over time. For borrowers, it is important to seek lower interest rate, while savers aim for higher interest rate to maximize their returns. Fifth question is, how does a credit score affect financial decisions? A credit score is a numerical representation of your credit worthiness, indicates how likely you are to repay your borrowed money. Higher credit scores open doors to better loan terms, lower interest rates, and increased access to credit. Lenders use credit scores to assess the risk of lending to an individual, making it a significant factor in financial decisions. Maintaining a good credit score involves paying bills on time, managing credit responsibly, and avoiding excessive debt. A positive credit history empowers individuals to make significant financial moves, such as buying a home or starting a business with favorable terms. What is inflation? So, inflation is the gradual increase in the prices of goods and services over time. It erodes the purchasing power of money, meaning that the same amount of money buys fewer goods or services as time passes. Inflation is a natural economic phenomena influenced by factors like increased demand, production cost, or changes in currency value. Understanding inflation is vital for financial planning. It impacts long-term goals such as retirement by affecting the future value of money. Investments and savings need to produce to outpace inflation to maintain or increase their real value over time. What is 401k? So 401k is a retirement savings plan offered by many employers. It allows employees to contribute to a portion of their pre-tax income into an investment account. Some employers may match a percentage of these contributions. The money in a 401k grows tax deferred until retirement, at which point withdrawals are taxed. 401k serves as a powerful tool for building a retirement nest egg. The pre-tax contributions lower your taxable income, and the compounding growth over time enhances the overall savings. It's a key component of many individuals' retirement strategies. How does diversification works in investments? So diversification is a risk management strategy that involves spreading investment across different assets to reduce exposure to any single investment poor performance. The idea is not to pull all your eggs in one basket. By diversifying, you can potentially capture positive returns from different sources and minimize the impact of negative events on your overall portfolio. For instance, instead of investing all your money in a single stock, you might spread it across stocks from various industries, bonds, and other asset classes. Diversification doesn't eliminate risk, but it aims to create a more balanced and resilient investment portfolio. What is a mortgage? A mortgage is a type of loan used to purchase real estate, typically a home. The property itself serves collateral for the loan. When you take out a mortgage, you borrow a specific amount of money from a lender and you agree to repay it over a set period, usually 15 to 13 years with interest. Mortgages make home ownership achievable for many people by spreading the cost over an extended period. Monthly payments cover both principal, the loan amount, and the interest. Understanding the terms and payments of mortgages is essential for making informed decisions when you're buying a home. Why is emergency savings important? So emergency savings are financial safety net designed to cover unexpected expenses or temporary loss of income. These funds act as cushion, preventing individuals from going into debt during challenging times such as job loss, medical emergencies, or unexpected home repairs. Having emergency savings provides peace of mind and financial security. It allows you to weather unexpected storms without disrupting your long-term financial goals. Financial experts often recommend setting aside 3 to 6 months worth of living expenses in an easily accessible account for emergencies. This reserves this reserve ensures you can navigate rough patches without derailing your overall financial well-being. What is a mutual fund? A mutual fund is a investment vehicle that pools money investors from many investors to buy a diversified portfolio of stocks, bonds, or other securities. It offers individual investors access to a professionally managed and diversified investment portfolio, spreading the risk across various assets. Investors in mutual funds own shares, and the fund's value is determined by the performance of its underlying investment. Mutual funds are popular for their accessibility and convenience, allowing investors to benefit from the expertise of professional fund managers without the need of significant capital or extensive market knowledge. How does compound interest work? Compound interest is the interest calculated on the initial principal and accumulated interest from previous periods. It's often referred to as a interest on interest. In simple terms, when you earn interest on your savings, the interest is added to the principal, and subsequent interest calculations are based on the increased total. Uh, the power of compound interest becomes evident over time. The longer your money compounds, the more it grows exponentially. This is why financial experts often emphasize starting to save and invest early, as it allows more time for compounding to work its magic. What is the difference between a debit card and a credit card? A debit card and a credit card are both plastic cards used for transactions, but they function differently. A debit card is linked to your bank account, and when you make a purchase, the funds are directly withdrawn from your account. It's essentially an electronic check. On the other hand, a credit card allows you to borrow money from a up to a certain limit. When you make a purchase with a credit card, you are essentially taking a short-term loan. You need to pay back the borrowed amount, usually on a monthly basis. Credit cards can be a useful tool for building credit, but it's important to use them responsibly to avoid debt. What is a credit report? A credit report is a detailed report of an individual's credit history and financial behavior. It includes information about credit accounts, payment history, outstanding debts, and public records. Credit reporting agencies compile this information to generate a credit score which lenders use to assess the risk of lending money to an individual. Regularly reviewing your credit report is essential to ensure its accuracy and identify any potential issues. A positive credit report with a high credit score can open doors to favorable loan terms, lower interest rates, and various financial opportunities. How does the stock market work? The stock market is a marketplace where buyers and sellers trade stocks. Stocks represent ownership in a company, and their prices fluctuate based on a supply and demand, economic conditions, and the performance of the companies issuing the stocks. Investors aim to profit from the stock market by buying stock at a lower price and selling them at a higher price. The stock market plays a crucial role in the economy by facilitating capital raising for companies and providing individuals with opportunities to invest and build wealth over time. What is the budget surplus? A budget surplus occurs when income exceeds expenses. In simpler terms, you are earning more money than you are spending. This surplus provides an opportunity to save, invest, or pay down debt. Governments with budget surplus can allocate funds to public services, reduce debt, or build reserves. While a budget surplus is generally considered positive, it's important to have a balanced approach. Saving or investing surplus funds wisely can contribute to financial stability and future goals, ensuring that the extra income is utilized effectively. What is Roth IRA? A Roth IRA, which stands for Individual Retirement Account, is a retirement savings account that offers unique tax advantages. Unlike traditional IRAs, contribution to a Roth IRA are made with after-tax income. The key benefits is that qualified withdrawals, including earnings, are generally tax-free in retirement. Roth IRAs are popular for individuals who expect their tax rate to be higher in retirement than it is when making contributions. They provide flexibility and tax advantages, making them a valuable tool for building a tax-efficient retirement savings strategy. What is risk tolerance? Risk tolerance is an individual's ability to endure fluctuations in the value of investments without feeling undue stress or anxiety. It is a crucial factor for in determining the appropriate investment strategies. People with higher risk tolerance may be comfortable with more volatile investments, potentially aiming for a higher returns. In contrast, those with lower risk tolerance may prefer more stable, conservative investments. Understanding your risk tolerance is essential for constructing an investment portfolio aligned with your financial goals and comfort level. A well balanced portfolio reflects both risk tolerance and the time horizon for your investments. Why is it important to have financial goals? Financial goals serves as a roadmap for managing money effectively and achieving desired outcomes. Whether it's buying a home, saving for education, or planning for retirement, clear financial goals provide direction and purpose to your financial decisions. Setting specific, measurable, achievable, relevant, and time-bound, smart financial goals helps prioritize spending, saving, and investing. Regularly reviewing your and adjusting these goals ensure that your financial plan remains dynamic and responsive to changing circumstances, helping you stay on track towards financial success. What is a 5 to 9 plan? A 5 to 9 plan is a tax advantage savings plan designed for education expenses. It allows individuals to save for qualified education expenses such as tuition and room and board in a flexible and tax efficient manner. Contributions to a 5 to 9 plan are made with after tax dollars. Both but qualified withdrawals, including earnings, are generally tax free. 5 to 9 plans are often used to save for college, and they come in two main types: prepaid tuition plans and education savings plan. These plans provide a valuable tool for parents and families to invest in their children's education and reduce their financial burden for educational expenses. What is the difference between a traditional IRA and a Roth IRA? Both traditional and Roth IRAs are individual retirement accounts, but they differ in their tax treatment. In a traditional IRA, contributions are made with pre-tax dollars, potentially reducing your taxable income in the contribution year. However, withdrawals in retirement are taxed as ordinary income. On the other hand, Roth IRA contributions are made with after-tax dollars, providing no immediate tax deduction. The significant advantage is that qualified withdrawals, including earnings, are generally tax-free. Choosing between the two depends on factors like your current and future tax situation. How does insurance work? So, insurance is a financial arrangement designed to mitigate the financial impact of a specific risk. Individuals pay premiums to an insurance company, and in return, the insurer provides coverage against specified events such as accidents, illness, or property damage. If the insured event occurs, the insurance company pays out benefits as outlined in the policy. Insurance is crucial for managing unexpected financial burdens. It provides a safety net protecting individuals and businesses from substantial financial losses during challenging times. Common types of insurance include health insurance, life insurance, auto insurance, and homeowners renters insurance. What is a credit union? A credit union is a member-owned financial institution that provides banking services. Unlike traditional banks, credit unions are not for-profit entities, and their primary goal is to serve their members rather than generate profits for shareholders. Members pool their money by making deposits, and the credit union uses these funds to provide loans and other financial services. Credit union often offer competitive interest rate on loans and savings account. Members typically have a voice in the credit union's decisions. Electing a board of directors, joining a credit union can be a way to access financial services with a focus on community and member well-being. Why is it important to have a emergency fund? An emergency fund is a crucial component of financial planning. It is a reserve of money set aside to cover unforeseen expenses or income disruptions such as medical emergencies, car repairs, or job loss. The purpose of an emergency fund is to prevent individuals from resorting to a high interest debt or depleting long term savings during unexpected financial challenges. Maintaining an emergency fund provides financial security and peace of mind. It acts as a financial safety net, allowing individuals to navigate tough situations without compromising their overall financial health. What is 403B plan? A 403B plan is a retirement savings plan available to certain employers, typically those in the non-profit sector such as schools, hospitals, and religious organizations. Similar to a 401k, a 403B allows employees to contribute a portion of their salary on a tax deferred basis. Some employers may offer matching contributions and enhancing the retirement savings potential. The funds in a 403B plan can be invested in a variety of options, such as mutual funds or annuities, like other employer sponsored retirement plans. Withdrawals from 403B are generally taxed at ordinary income rates in retirement. How does the Federal Reserve influence the economy? So, Federal Reserve, often referred to as the Fed, is the central bank of the United States. It plays a crucial role in influencing the economy through various monetary policy tools. The Fed's primary objectives include promoting maximum employment, stable prices, and moderate long-term interest rates. The Fed influences the economy by setting the federal funds rate, which in turn affects interest rates throughout the economy. By adjusting interest rates, the Fed aims to control inflation, encourage or discourage borrowing and spending, and stabilize the overall economic environment. What is FICO score? A FICO score is a credit score developed by the Fair Isaac Corporation, and it is widely used by lenders to assess an individual's credit worthiness. FICO scores ranges from 300 to 850, a higher score indicating better credit worthiness. The score is based on various factors including payment history, amount owed, length of credit history, new credit, and types of credits used. A higher FICO scores increases the likelihood of being approved for loans and credit cards and may result in more favorable interest rates. Managing credit responsibly, paying bills on time, and avoiding excessive debt are essential for maintaining a positive FICO score. What is the time value of money? The time value of money is a fundamental financial concept that recognizes the idea that a sum of money has a different value today than it will in the future. This is due to the potential earning capacity of money over time. In simpler terms, a dollar today is worth more than a dollar in the future. Understanding the time value of money is crucial for various financial decisions, including investing, borrowing, and saving. It emphasizes the importance of considering the impact of interest rates and inflation when evaluating the present and future value of money. How does a 5 to 9 plan differ from a Coverdell ESA? Both 5 to 9 plans and Coverdell education savings accounts are tax advantage accounts designed to help save for education expenses. However, they have key differences. A 5 to 9 plan is a state sponsored plan savings plan with higher contribution limits. Contribution grow tax free and withdrawals for qualified education expenses are also tax free. On the other hand, a Coverdell ESA has lower contribution limits but it offers more flexibility in investment choices like a 5 to 9 plan contribution grows tax free and withdrawals for qualified education expenses are tax free. Understanding the features of each plan helps individuals choose the most suitable option for their education savings goal. What is a bear market? A bear market is a term used to describe a financial market characterized by declining prices, pessimism among investors, and a general lack of confidence. During a bear market, stock prices may fall by 20% or more from recent highs. Bear markets often coincide with economic downturns and they have a significant impact on the investment portfolios. Investors in a bear market may adopt defensive strategies such as shifting to more conservative investment or reducing exposure to stocks. Understanding the nature of bear market is crucial for managing risk and making informed investment decisions during challenging conditions. What is bull market? Conversely, a bull market is financial market characterized by rising prices, optimism among investors, and a general sense of confidence. In a bull market, asset prices, particularly stocks, experience prolonged growth. This positive sentiment often reflects a strong economy, increased corporate profits, and overall economic expansion. Investors in a bull market may take an optimistic approach with a focus on potential for capital appreciation. It's important to note that markets naturally cycle between bull and bear phases, and understanding these market conditions is vital for informed investment decisions. How does the cost of living affects personal finance? The cost of living refers to the average cost of basic necessities like housing, food, transportation, and healthcare in a specific location. It directly influences the it directly influences finance by determining how much money is needed to cover essential expenses. Understanding the cost of living in a particular area is crucial for budgeting, financial planning, and deciding where to live. A higher cost of living may require individuals to allocate more of their income to basic needs, potentially impacting their ability to save or invest. Cost of living adjustments are also considered in salary negotiation and retirement planning. What is the difference between a traditional 401k and a Roth 401k? Similar to the primary distinction between a traditional 401k and a Roth 401k lies in the tax treatment of contributions and withdrawals. In a traditional 401k, contributions are made with pre-tax or dollars, reducing taxable income in the contribution year. Withdrawals in retirement are then taxed at ordinary income. In contrast, a Roth 401k involves after-tax and contributions providing no immediate tax deduction. However, with qualified withdrawals, including earnings, are generally tax-free in retirement. The choice between the two depends on factors such as current and future tax situations and retirement income goals. How does economic inflation affect purchasing power? Inflation, the gradual increase in the prices of goods and services over time erodes the purchasing power of money. This means that the same amount of money can buy fewer goods or services as prices rise. The impact of inflation is significant in personal finance because it affects the real value of money over time. Understanding inflation is crucial for budgeting and financial planning. Investors and savers must consider inflation when evaluating the longer term growth of their assets to ensure that their purchasing power is maintained or increased in the face of rising prices. What is the dividend? A dividend is a payment made by a corporation to its shareholders, typically in the form of cash, but sometimes as additional shares of stock. Dividends are a share of company's profits distributed to investors as a reward for holding their shares. They are often considered a source of passive income for the investors. Dividend paying stocks can be attractive to income focused investors. Receiving regular dividends provides a steady income stream, and companies with a history of consistent dividends payments are often viewed as financially stable. How does 457B differ from a 401k? A 457B plan is a retirement saving plan specifically designed for certain government and non-profit employees. While both 457B and 401k plans share similarities such as allowing tax deferred contribution, there are key differences. One notable distinction is the lack of an early withdrawal penalties in a 457B plan, making more flexible for employees approaching retirement age. 457B plans are subject to unique catch-up provisions, allowing participants to contribute more in the 3 years leading up to a moral to the normal retirement age. Understanding these differences help employees make informed decisions based on their specific retirement needs. What is the rule of 72? The rule of 72 is a simple formula used to estimate the number of years it takes for an investment to double in the value based on fixed annual rate of return. To apply the rule, divide 72 by the annual rate of return. The result is an approximation of the number of years it will take for an investment to double. For example, with 6% annual return, it would take approximately 12 years for an investment to double. 72 divided by 6 equals to 12. So, while a rough estimate, the rule of 72 provides a quick and useful tool for estimation for understanding the potential growth of investments over time. How does a student loan interest work? Student loan interest is the cost associated with the borrowing money for education expenses. It occurs over time based on the interest rate and outstanding balance of the loan. There are typically two types of students loan interest: subsidized and unsubsidized. In subsidized loans, the government covers the interest during specified periods, such as while the borrower is in school or during deferment. Unsubsidized loans accrue interest from the time they are disbursed, even during periods of deferment or forbearance. Understanding the type of interest on your student loan is crucial for managing repayment effectively. What is liquidity in financial terms? Liquidity refers to the ease with which an asset can be converted into cash without significantly affecting affecting its market price. Cash is the most liquid asset, which because it can be readily used for transportation, other assets like real estate or certain investments. Liquidity is a vital consideration in financial planning. Having liquid assets ensure the ability to cover immediate expenses or take advantage of investment opportunities. Balancing the need for liquidity with a long-term financial goal is essential for a well-rounded financial strategy. Why is it essential to review and update financial goals regularly? Reviewing and updating financial goals regularly is essential for ensuring that your financial plan aligns with your evolving needs and circumstances. Life is dynamic, and financial goals should adapt it to changes in income, expenses, family situations, and economic conditions. Regular reviews allows you to assess progress, identify new opportunities, and make necessary adjustment to stay on track. It's an opportunity to realign your goals with your current priorities and ensuring that your financial plan remains relevant and effective in guiding your journey toward financial success. How does a home equity loan work? A home equity loan allows homeowners to borrow against equity in their home. Equity is the difference between the home's current market value and the outstanding mortgage balance. Homeowners can access uh, this equity in the form of a loan receiving a lump sum amount. The interest rates on home equity loans are often lower than other type of loans, and interest paid may be tax deductible. Repayment is typically made in fixed monthly installments over a set period. Home equity loans are commonly used for major expenses like home renovations, education, or debt consolidation. What is the purpose of a will? In a estate planning? A will is a crucial component of estate planning. It is a legal document that outlines an individual wishes regarding the distribution of their assets and the care of any dependents after their death. In a will, one can specify beneficiaries, designate guardians for minor children, and address other important matters. Having a will ensures that your assets are distributed according to your wishes and can help avoid conflict among family members. It simplifies the probate process and provides clarity on the administration of the estate. Regularly updating a will is important to reflect changes in circumstances or preferences. How does supply and demand impact prices in the stock market? The principle of supply and demand is fundamental to understanding stock market prices. If demand for a particular stock increases while the supply remains constant, the stock prices tend to rise. Conversely, if supply exceeds demand, the price may decline. Factors such as company performance, economic conditions, and investor sentiment influence supply and demand dynamic. Trader and investor analyze these factors to make informed decisions. The interaction of supply and demand plays a central role in determining the value of stocks and other securities in the financial markets. What is the role of a financial advisor? A financial advisor is a professional who provides guidance and advice on various aspects of personal finance. Their role includes helping individuals set financial goals, creating investment strategies, managing risk and financial and planning for retirement. Financial advisors analyze the client's performance, financial situation, considering income, expenses, assets, and liabilities to develop tailored recommendations. Beyond investments, financial advisors may assist with tax planning, estate planning, and insurance decisions. Their expertise helps client make informed decisions aligned with their financial objectives, providing a comprehensive approach to wealth management. How does a traditional pension plan work? A traditional pension plan, also known as defined benefit plan, is a retirement arrangement provided by some employers. In this plan, retirees received a fixed regular payment based on factors such as salary and years of service. The employer bears the investment risk, ensuring that retirees receive a stable income during their retirement years. The amount of pension is typically determined by a formula that considers the employee's salary and the number of years worked for the company. Unlike defined contribution plans where the retiree's income depends on investment returns, a traditional pension plan offers a predictable stream of income. What is the what is the difference between gross income and net income? Gross income is the total earnings before any tax deductions such as taxes, insurance, or retirement contributions. Represents the amount earned before any expenses or withholdings. Net income, on the other hand, is the amount an individual takes home after deducting all the applicable taxes and deductions from the gross income. Net income is what individuals have available for spending, saving, or investing. Understanding the difference between gross and net income is crucial for budgeting and financial planning as it provides a realistic picture of one's financial resources. How do capital gains taxes work? Capital gains taxes are levied on the profits realized from the sale of investments or assets. The tax is applied to the difference between the sale price and the original purchase price. Capital gains can be categorized as either short term or long term, depending on the holding period. Short-term capital gains from assets held for 1 year or less are taxed at ordinary income rates, which can be higher. Long-term capital gains from assets held for more than 1 year typically enjoy lower tax rates. Understanding the tax implications of capital gains is essential for investors and can impact overall investment strategies. What is a 457B plan? A 457B plan is a type of deferred compensation plan available for government employees and some non-profit workers. It allows participants to contribute a portion of their income on a tax deferred basis, meaning the contributions are made before taxes are applied. This reduces the participants' taxable income for the year. The funds in a 457B plan can be invested and the contributions grow tax deferred until withdrawal. Withdrawals are generally allowed without penalty upon separation from service and they are taxed as ordinary income. The 457B plan provides an additional option for retirement savings, particularly for public sector employees. Why is it important to maintain a good credit score? A good credit score is essential for various financial transactions and opportunities. Lenders use credit scores to assess the risk of lending money to individuals. A higher credit score indicates a lower risk, which can lead to more favorable loan terms, lower interest rate, and higher credit limits. A good credit score is crucial when applying for mortgages, auto loans, credit cards, or personal loans. It can also influence approval for rental agreements, insurance premiums, and even job opportunities. Regularly monitoring and maintaining a good credit score opens door to financial flexibility and favorable terms. How does dollar cost averaging works in investing? Dollar cost averaging is an investment in the strategy that involves consistently investing a fixed amount of money at regular intervals. Regardless of the investment's price, this approach reduces the impact of market volatility on the overall investment. When prices are high, the fixed investment amount buys fewer shares. When prices are low, it buys more shares. Over time, this strategy can result in a lower average cost per share. Dollar cost averaging helps investors avoid the stress of trying to time the market and promotes disciplined long-term investing habits. What is the role of a stockbroker? A stockbroker, also known as securities broker or investment broker, is a licensed professional who facilitates the buying and selling of financial securities such as stocks, bonds, and mutual funds on behalf of clients. Stockbrokers may work for brokerage firms or as independent brokers. Their role include providing investment advice, executing trades, and keeping clients informed about market trends. Some brokers also offer additional financial services such as retirement planning and portfolio management. Clients often rely on stockbrokers for their expertise and assistance in navigating the complexities of the financial markets. How does a health savings account work? A health savings account (HSA) is a tax advantaged savings account designed for individuals with high deductible health plans, which is HDHPs. Contributions to an HSA are made with pre-tax dollars, reducing taxable income. These funds can be used to cover qualified medical expenses, including deductibles, co-payments, and certain other healthcare costs. One notable advantage of an HSA is that unused funds can roll over from year to year, allowing for long-term savings. Additionally, after age 65, withdrawals for non-medical expenses are penalty-free, though subject to regular income tax, making HSAs a unique and versatile tool for healthcare-related financial planning. What is the significance of the Dow Jones Industrial Average? The Dow Jones Industrial Average, which stands for DJIA, often referred to as Dow, which is a widely followed stock market index that represents a selection of 30 major American companies across various industries. It serves as an indicator of the overall health of the stock market and the broader economy. Changes in the Dow reflect collective payment of the included companies, stocks, investors, and financial professionals. Use the Dow as a benchmark to assess market trends and make investment decisions. While it's just for many indices, The Dow's long history and diverse component companies contribute to its reputation as an important gauge of market conditions. What is an individual development account, which stands for IDA? An IDA is a specified savings account designed to help low income individuals build assets and achieve specific financial goals such as homeownership, education, or starting a business. Participants contribute to the account, and these contributions are often matched by public or private funds. The goal is to encourage disciplined savings and provide financial assistance to individuals working towards safe improvement. IDs are a unique tool in promoting financial inclusion and helping individuals break the cycle of poverty by providing a structured path to long-term financial stability. How does a reverse mortgage work? A reverse mortgage is a financial product available to homeowners aged 62 and older. It allows them to convert a portion of their home equity into cash while still living in the home. Unlike a traditional mortgage where the borrower makes monthly payment to the lender, in a reverse mortgage the lender makes payment to the borrower. Repayment typically occurs when the homeowner sells the home, moves out, or passes away. Reverse mortgage can provide a source of income for retirees but come with considerations such as potential impact on the inheritances and the need to maintain the home. What is the significance of the Consumer Price Index? The Consumer Price Index, it stands for CPI, is a measure for the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. It stands as a key indicator of inflation, reflecting the rising or following cost of essential items like food, housing, clothes, and transportation. The CPI is widely used by economists, policymakers, and businesses to assess inflation's impact on the cost of living. It helps individuals understand how their purchasing power may change over time and informs decisions related to budgeting, investment, and economic policy. How does diversification work in an investment portfolio? Diversification is a risk management strategy in which an investor spreads their investments across different assets classes, industries, and geographic regions. The goal is to reduce the overall risk of portfolio by avoiding over concentration in any single investment. Diversification aims to capture positive returns from various sources while minimizing the impact of poor performance in any one area. For example, a diversified portfolio might include stocks from different sectors, bonds with varying maturities, and investment in different countries. While diversification does not eliminate risk entirely, it can enhance the portfolio's resilience and balance. What is the role of Securities and Exchange Commission? The SEC is a US government agency responsible for regulating and overseeing the securities industry, including securities exchange brokers and investment advisors. Its primary mission is to protect investors, maintain fair and efficient markets, and facilitate capital formation. The SEC achieves its goal through enforcing securities laws, regulating disclosures, and overseeing the conduct of market participation by ensuring transparency and fair practices in the financial market. The SEC plays a crucial role in fostering confidence among investors and promoting the integrity of the securities industry. How does a 403B plan differ from a 401k plan? While both 403k and 401k plans are employer-sponsored retirement savings plan, they differ in terms of eligibility and the types of organization that offer them. A 401k plan is typically offered by for-profit companies, allowing employees to contribute a portion of their salary on a tax-deferred basis. On the other hand, a 403 plan is designed for certain employees of tax-exempt organizations such as school, hospital, and religious institutions. It also allows tax-deferred contribution, often with additional catch-up provisions for older employees. Understanding these differences help employees choose the retirement saving plan and that aligns with their specific employment situations. What is the role of a credit counseling service? Credit counseling services are organizations that provide assistance to individuals facing financial challenges, particularly those related to debt management and credit issues. Certified credit counselors offer creditors on behalf of clients to establish more manageable repayment plans. The goal of credit counseling is to help individuals regain control of their finances, improve their credit standing, and avoid bankruptcy. It's important to choose reputable credit counseling services that prioritize the client's best interest and adhere to ethical practices. What is the difference between a traditional mortgage and an adjustable rate mortgage? A traditional mortgage, also known as a fixed rate mortgage, has a constant interest rate and monthly payments that do not change over the life of the loan. This provides predictability and stability for homeowners. In contrast, a adjustable rate mortgage has an interest rate that may change periodically. Typically, after an initial fixed period, the rate adjustment are based on market conditions, and as a result, monthly payments may increase or decrease. Homeowners often choose between the two based on their preferences, risk tolerance, and expectations regarding interest rate movements. How does a bankruptcy affect a person's credit score? A bankruptcy can have a significant impact on a person's credit score. When an individual files for bankruptcy, it remains on their credit report for a specific period. Depending on the type of bankruptcy, Chapter 7 or Chapter 13, during this time, obtaining a new credit may be challenging and existing credit accounts may be affected. What is the purpose of a required minimum distribution in a retirement account? A required minimum distribution is the minimum amount that individuals must withdraw annually from their retirement accounts, such as traditional IRAs and 401ks. Once they reach a certain age, currently 72 years old, the purpose of RMD is to ensure that the individuals use their retirement savings for retirement income and pay the necessary tax on their distributions. How does a recession impact personal finance? A recession characterized by a significant decline in economic activity can have various impacts on personal finances. Job losses, reduced income, and declining asset values are common challenges during recessions. Individuals may experience difficulty in finding employment, and those with existing investment may see an increase in their portfolio values. What is the purpose of 401k vesting schedule? A 401k vesting schedule determines when employers become fully entitled to the employer contributed funds in their retirement accounts. Vesting schedules are typically used to encourage employee retention by rewarding long-term service. There are two types of vesting schedules: cliff vesting, where employers become fully vested after a specified number of years, and grade vesting, where vesting occurs gradually over time. How does a health reimbursement account work? A health reimbursement account is an employer funded benefit that helps employees cover qualified medical expenses. Employer contribute funds to the HRA on behalf of employees, and these funds can be used to pay for eligible healthcare expenses such as deductibles, co-payments, and prescription medications. What is the difference between simple interest and compound interest? Simple interest is calculated only on the initial payment, principal amount of the loan or investment. It does not take into account the interest that occurs on previously earned interest. In contrast, compound interest considers both the principal and the accumulated interest, leading to interest being calculated on the updated total. Compound interest has a compounding effect over time, allowing the interest to grow exponentially. It is commonly used in savings account and investment. Understanding the distinction between simple and compound interest is important when evaluating the potential growth or cost of loans and investment. How does a LLC protect personal assets? A LLC is a business structure that provides personal liability protection for its owners, such as members. The key benefit is that LLC separates personal assets from business liabilities. In the event of legal actions, debts, or lawsuits against the business, the personal assets of the members are generally protected. This limited liability feature helps shield personal finances such as homes and savings from business related risk. However, it's essential for LLCs to maintain proper legal formalities to follow regulations to ensure the preservation of this protection. What is the purpose of home appraisal in the mortgage process? A home appraisal is an evaluation conducted by a professional appraiser to determine the fair market value of a property. In the mortgage process, the appraisal is crucial for both the lender and the borrower. Lender uses the appraisal to assess property's value and ensure that it serves as sufficient collateral for the loan. How does a money market account differ from a savings account? Both money market accounts and saving accounts are interest-bearing deposit accounts, but they differ in certain aspects. Money making accounts typically offer higher interest rate than regular saving account. They may also provide check writing and debit card capabilities, allowing more convenient access to funds. How does a dividend reinvestment plan work? A dividend reinvestment plan works. A DRIP allows investors to automatically reinvest the cash dividends they receive from owning stock back into additional shares of the same stock. Rather than receiving a dividend payments in the cash, investors who participate in a DRIP receive additional shares. This process helps to compound returns over time by increasing the number of shares owned, which in return can lead to more significant dividend payments in the future. What is the difference between a traditional 401k and a Roth 401k? A traditional 401k and a Roth 401k are retirement saving plans offered by employers, but they differ in their tax treatment. In a traditional 401k, contributions are made with pre-tax dollars, reducing the individual's taxable income in the current year. However, withdrawals in the retirement are subject to income tax. On the other hand, is Roth 401k allows individuals to contribute after tax dollars, meaning contributions are not tax deductible. However, qualified withdrawals, including earnings, are tax-free in retirement. Choosing between the two depends on factors such as current and future tax situation and individual financial goals. How does a stock buyback impact shareholders? A stock buyback, also known as share repurchase, occurs when a company buys its own shares on the open market. This can be done for various reasons, such as returning excess cash to shareholders, signaling confidence in the company's future, or improving earnings per share. The impact on shareholders is generally positive. By reducing the number of outstanding shares, a stock buyback can increase earning per share, making each share more valuable. It can also provide shareholders with a cash return if the buyback is conducted at a premium to the current market price. What is the purpose of a home inspection in real estate transactions? A home inspection is a critical step in the real estate buying process. It involves hiring a qualified inspector to assess the condition of a property, including its structural integrity, electrical systems, plumbing, and other components. The purpose is to identify any potential issues or needed repairs before the transaction is finalized. A thorough home inspection helps home buyers and informed decisions about the property and may provide leverage for negotiations, repairs, or adjustments to the purchase price. For sellers, uh, addressing issues discovered during an inspection can enhance the marketability of the property. How does a 457F plans differ from a 457B plan? While both 457F and 457B plan are retirement saving options, they differ in terms of eligibility and benefits. A 457B plan is offered to employees of government and certain non-profit organizations, allowing them to make pre-tax contributions, and it may include employer matches. On the other hand, a 457F plan is typically for highly compensated executives in non-profit organizations. It may include deferred compensation arrangement with employer contribution, but the funds are subjected to a substantial risk of forfeiture. Understanding the distinction helps employees to choose the plan that aligns with their employment situation and financial goals. How does a budget contribute to financial well-being? A budget is a financial tool, is a fundamental tool for managing finances uh, and contributing to financial well-being. It helps individuals plan and allocate money for various needs, such as housing, food, transportation, and savings. By tracking income and expenses, a budget provides a clear picture of where money is going and allows for informed financial decision making. A well-crafted budget can prevent overspending, identify areas for potential savings, and helps individuals work toward financial goals. It provides a sense of control over finances and serves as a roadmap for achieving short-term and long-term financial objectives. What is the role of Federal Reserve in the US economy? The Federal Reserve, often referred to as the Fed, is the central bank of the United States and plays a crucial role in the country's economy. Its primary responsibilities include conducting monetary policy, supervising and regulating banks, and maintaining financial stability. The Fed aims to promote full employment, stable prices, and moderate long-term interest rates. To implement monetary policy, the Fed influences interest rates and controls the money supply. It also acts as a lender of last resort during financial crises. Through its various tools and functions, the Federal Reserve seeks to support economic growth while maintaining overall stability in the financial system. How does a 403b plan differ from a 401k plan for retirement savings? While both 403b and 401k plans are employer sponsored retirement saving options, they differ in terms of the types of organizations that offer them. A 401k plan is typically offered by for profit companies, allowing employees to contribute a portion of their salary on a tax deferred basis. In contrast, a 403 plan is designed for employees of certain tax exempt organizations such as schools, hospitals, and religious institutions. It also allows tax deferred contributions, often with additional catch up provisions for older employees. Understanding these differences helps employees choose the retirement savings plan that aligns with their specific employment situation. How does a money market fund differ from a money market account? While both money market funds, which stands for MMFs, and money market accounts, which stand for MMAs, involve short-term low-risk investments, they differ in their structure and regulations. A money market fund is a type of mutual fund that invests in short-term, high-quality securities like government bonds and commercial paper. It is not FDIC insured and its returns are based on market conditions. On the other hand, a money market account is a type of savings account by banks and credit unions. It is FDIC insured, providing a higher level of safety. MMAs often have limited check writing and debit card capabilities, making them suitable for individuals seeking liquidity and safety. How does economic globalization impact businesses and consumers? Economic globalization refers to the increasing interconnectedness and interdependence of economies around the world. It has profound effects on business and consumers. For businesses, globalization opens up new market, enhances access to resources, and allows for greater efficiency through global supply chains. However, it also introduces challenges such as increased competition and exposure to global economic volatility. Consumers benefit from globalization through access to a wider range of products and services, often at lower prices. However, it can also lead to job displacement and income inequality. Understanding the implications of economic globalization is crucial for both businesses and consumers navigating the complexities of the global economy. So, these were the 100 basic finance definitions and their answers. So, we started from the basic question like what is finance and why is budgeting important, and what is the difference between stocks and bonds, what is interest rate. Then we move on to what is budget surplus, what is Roth IRA. Then we moved over to some harder definitions like 403B plan, what is 403B plan. Then the next one was how does the cost of living affect personal finance. Then what is dividend? So we move on to the share market definitions. Then the next were what is the role of a financial advisor, and some more questions like what is IDA account, what is individual development account, and then we move on to how does bankruptcy affects a person credit score. Then the next were how does a dividend reinvestment plan, that means full form for DRIP, work. Then we move on to what is the role of the Federal Reserve in the federal in the US economy. And then the last question that we answered was how does economic globalization impact businesses and consumers. So these were some basic finance questions and answers. Thank you.